Welcome everybody to Safe Option Strategies presentation of adjusting the bear put spread. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. So as is our policy or our method of doing things, let's review the bear put spread from the previous class. The bear put spread is a debit spread, which means we buy to open the trade, we sell to close the trade. It takes advantage of a strong bearish move, oftentimes following technical crossovers and a catalyst event such as an earnings report, maybe a retail sales report, something of that nature. The long put is placed at or just out of the money, and typically 45 to 90 days to expiration. This is our primary or our money-making option. The short put is placed one or two strike prices lower, and in the same month or week of expiration, this is our secondary or our hedging option. Our cost basis of the trade, or the net debit, is simply what we pay for the long put minus what we take in or receive back as a credit on the short put. It's basically the money out minus the money in. It's as simple as that. If that's not resulting in a debit, you're probably not doing the right trade. Our maximum risk is, of course, equal to that cost basis, and our maximum reward, the difference between the strike prices minus whatever that cost basis is or whatever we pay per share to be in the trade. A good target return on investment can be anywhere from 15 to 30%. Most often we're going to target 20 to 25%, and we love to be in this trade for 2 or 3 weeks. 6 weeks or less is kind of a strong target. We really don't want to be in a bull put spread more than 6 weeks. If we are, chances are we will have adjusted that trade, or we certainly will need to adjust the trade. So here's what often happens, or can happen. I shouldn't say often. Here's what can happen and what is very frustrating when we do a bear put spread. We get our 3 technical crossovers. Now assume that other one is down here on the MACD. We get our technical indicators, our technical crossover. We do all of our due diligence. We check news reports. We see what the general conditions of the market are. Why is this stock trending the way it is? What's going on? What's the reason for it? And we begin to get this downward trend. And by the time we open the trade, which is probably right in here, and this thing has moved down here, it hasn't quite gone far enough to get us profitable. And before we can get out and exit, it's moving back to the upside. And now we're scratching our head and saying, what do we do? It would be great if every time we got these crossovers, we got this kind of a continued bearish trend. That's the perfect scenario. It's off the screen over here a little bit to the left. That's supposed to be an arrow right there. It's off the screen a little bit to the left, but when technical crossovers came here, there was a nice continued bearish trend. More than enough distance to give us the kind of profit we're looking for, the easy exit strategy on a bear put spread. But this happens once in a while. We get these quick reversals going back the other direction, and it can be very frustrating. So when that's happening, what do we do? Where do we go from there? All right. When we set up our bear put spread, we're usually, we see the crossovers right here, so we're assuming that maybe the stock was trading right about here, and this would be the long put that was just out of the money. Doesn't even matter what the strike price is. We're out 45 to 90 days. I know this shows just a couple of months right here, but imagine these are greater time increments here and that we're out 45 to 90 days on this trade. All right. So that sets the stage for what do we do now? We're expecting that bearish move, and if we got that bearish move, it would be easy to just pick the right time to close the trade. But we get in the trade, and instead of a bearish move, we start flattening out. So what the first adjustment we're going to look at is, what do we do if we're still moving bearish, but we can start drawing a line? Let's say we were looking right in this time period here. We start to draw this line, this trajectory line, and we start saying, you know what? On this trajectory, I'm not going to move far enough down in the price of that stock to get me the profit I need inside of that 6 weeks. Maybe my long option is farther out than that, my short option are farther out than that. So maybe I've got more time before I have to exit the trade or before I'm right up against the expiration of the options. But I can see that that trajectory is not going to move that stock price far enough down for me to get the profit I want. So a very simple adjustment is to roll that short put into a nearer term expiration date, maybe down to a lower strike price, higher strike price. Whether or not you raise it to a higher strike price is going to depend on the line you draw for your trajectory. You don't want to move that option in this way and up here to where it would trend in the money. That's not a good thing for the stock price to be trading below the short put strike if you've just made an adjustment and these are now too close together in strike price for you to be guaranteed profit getting out. So you've got to be very cautious of that. Probably you're going to roll the option in. Maybe you roll it down. And some of that will also depend on, let's say hypothetically, that these were respectively, let's say this was a 50 strike price and this option was a 45 strike price. Well, when we set this trade up, and maybe we're out in September or October expiration on these options, there may only be the 45 and then the 50 strike price. There might not exist any strike prices in between here. But if we have to roll this option in, and now we have a 44 strike price, a 43 strike, or excuse me, I'm going the wrong way, a 46 strike price, a 47 strike price, a 48, a 49, if all those strike prices are available to us, it's easier when we roll into a nearer term expiration to maybe go to a higher strike price because we wouldn't automatically have to go right to the 50 strike price. There may be times if the stock is going perfectly flat or even turning to a slightly bullish direction, we might want to take that 45 in and up to a 50. But the idea is that if we're still getting bearish movement, it's just not the kind of bearish movement that we were hopeful for or expecting, and our best due diligence, drawing a line, drawing a trajectory, we're making an educated guess based on the trajectory line that we've got on where we can place the strike price of that new short put that we're opening. Once we're in a put calendar, whether it is a bear put calendar, a horizontal put calendar, a bull put calendar, whichever it might be, from that point on, when our short option expires worthless, then we can add a new short option. We might do that several times in weekly options before we end up back in the same month of expiration as the long put, or the same expiration date as the long put. So I mentioned this in the adjusting the bull call class. I'll mention it again here in the adjusting the bear put class. It may not be a bad idea, certainly wouldn't be a horrible idea, to skip ahead and watch the calendar spread class. I think it's the next couple classes coming up, or calendar spreads and adjusting calendar spreads. But you might want to look at those really closely, because once you've rolled this option in, whether you've gone up to a higher strike price or not, once you've done that, you are now in a calendar spread, and your next possible adjustment would simply follow the rules and follow the outline of what we teach for adjusting calendar spreads. Remember, I've said before, and I'll say it again right now, you're thinking like a chess player. You're thinking a couple moves ahead rather than just what do I do right now based on what I'm getting. That's the first thing you've got to think about. Then you've got to think a couple of moves ahead. Now, in the example we showed on the chart, before I blocked out some of the stock chart with our blank stock chart here, you saw that the stock reversed and actually gave technical crossovers, and the new trajectory has it going up like this. In a situation where you're moving into a bullish trend and the trajectory looks like the stock is going to, you've got to look at the trajectory. You've also got to look at levels of resistance. What trajectory is it on, and where might that slow down or stop based on the level of resistance? And depending on where that is at, you might roll your short put straight up above your long put, and in doing so, you create a bull put spread. Now, I will caution you right here. I'm going to give you a little piece of caution right here. Before you adjust to a bull put spread, look at what's available at a nearer term expiration, even if it's at a higher strike price than your long put, even if it's above the long put strike. Look at what is available at a nearer term expiration, because if you had to adjust again, the trickiest thing about any trade we enter into is not the first adjustment. The trickiest thing is when you have to adjust and then things turn and you have to adjust again. That is far more difficult than just the mechanics and the ease of making that first adjustment. So again, thinking like a chess player, you're thinking a couple of moves out in advance. If you can create a good situation by rolling to a nearer term option and only go up as high as you feel you need to in a strike price, if you get from that point forward, after you've made that adjustment, if you get another reversal or even just a slowdown or a flattening, it is far easier to adjust a calendar spread, whether it's a bull put calendar, a horizontal put calendar, or a bear put calendar. Adjusting a calendar spread is without a doubt easier than adjusting a bull put spread. Keep that in mind. This is where the chess master inside you all have a chess master somewhere inside you. Even if you don't like chess, somewhere inside you there is a chess master dying to get out, and you've got to bring that chess master out and start thinking 2 or 3 moves ahead on what you can do, because that will help you determine the best adjustment. Going to a bull put spread should be kind of the last resort adjustment. It's a very valid, very viable adjustment, but if you can achieve similar results and still give yourself some wiggle room by going into a calendar spread, you're going to be better off. And of course, if the stock price is moving up in reversing directions but doing it more slowly, a put calendar or bull put calendar, that's basically just what I was talking about, and then this screen is just illustrating it. Once you're in that put calendar or bull put or bear put calendar spread, whichever calendar you're in, as options expire, you can move them around, you can write new options. Now, like with any other trade, like with any other adjustment strategy we make, everything comes down to money in, money out. You want to keep track of the money in, money out. Now, I'm going to back up for just a moment. I talked about this in adjusting the bull call spread, and I need to address it in this class as well, in case it was a while ago that you watched that class, or in case you're going out of order a little bit. It is always easier to adjust a short put going up than it is going down. Why is that the case? For those of you that are with me live as I'm doing the class live right now, why is it the case that adjusting a short put is easier when the stock is moving up than it is when the stock is moving down? What would be the reason for that? What is happening? I'll make the question easier for you. What is happening to the value of a short put or any put option? Doesn't matter if it's a short or a long put. What is happening to the value of it when the stock is going up? The value of it, the price of it, is moving down, correct? If we started out with this short put right here, and let's go back and say, let's say this is maybe the 40 strike price short put. If we've got a 40 strike price short put, and let's say when we opened this trade, we brought in $1.30 per share, that was the credit that we took in on the short put. And we did that because we thought the stock was going down, and even though this would be going up in value, this would be going up in value faster, right? That's the simple mechanics behind it. But now we've got a reversal in direction, and instead the stock price is moving up. The value of this is going down. It's going from 130 down to 120, 110, $1, 90 cents, 80 cents, keep going. The farther the stock is going up, the more this is losing value. Initially, the role of the option is buy to close the existing short option and sell to open the new short option. Don't you initially want to buy to close this one for less than what you sold it for? And if you're moving up in strike price and getting closer to the money, you increase the chances that what you sell to open this one for is greater than what you bought to open this one for. It doesn't matter if it's calls or puts. What is our number one rule that we are trying to achieve? I always say trying because sometimes the best thing you're going to do is get close to it. But what are we always trying to do when we roll a short option? What are we trying to do? We're trying to get as much or more credit on the new short option as what we are spending to close the old short option. If we took in $1.30 for this option and we closed it for 80 cents, our goal is to get 80 cents over here. That's our goal. And if we're going to go into a nearer term expiration date, that takes away time value. We're going to have to move it up to a higher strike price, right? There's no choice but to go to a higher strike price if we want to capture that 80. If all we did was move from the September options to the August options and stayed at the same strike price, we're not going to successfully make that roll of the option and achieve our goal of bringing in as much money on the new one as what we're spending to close the old one. But if we also raise our strike price 1 or 2 strike prices higher, if this started out at 40 and say this started out at 50, we might have the 42.50, the 45, the 47.50. And if we're going to come in a couple weeks to as much as a month, we're going to, maybe a month and a half, we're going to want to roll that up. Now, contrast that with rolling in the other direction. Let me go back. If this is where we started, okay, actually, let's, okay, I'm sorry. If we're right here, and now the stock begins to move down again. So we made the adjustment up to it's not perfectly horizontal, but pretend for a minute that's a horizontal call calendar. If we make the adjustment to a call calendar, and now we get another reversal and the stock is going back down. Remember what I said a couple minutes ago? The first adjustment is always the easy one. The first adjustment is the easy one. It's if we have to make a second adjustment, that's when it can get more tricky. Well, same scenario. If we brought in, let's say we got the perfect situation when we closed that other one at 80, we got 80 cents a share for this one. But if the stock is now moving back down, what's happening to the value of this? It's going up, right? Now we might have to spend $1.10 or $1.15 a share to close this one. And that's okay, provided we can find $1.15 on one that's farther out in time. But we're going to have to, if we want to move the strike price this way, we're going to have to go farther out in time. And that's more challenging to do. Because if we pay $1.15 to close this one, what is the one 2 strike prices lower going to be? It might be $3. Excuse me, I'm sorry, I take that back. It might only be 75 cents. It might only be 60 cents. If we want to get more than this, we're going to have to add some time value to it and go farther out in time. That's a more difficult thing to do. With short puts, they're always easier to adjust moving to the upside. With short calls, they're always easier to adjust moving to the downside. So let's go back to the whole reason why I was stating this. If we were to adjust right into, there we are. If we were to adjust right to a bull put spread, this is where I wanted to get back to. If we were to adjust from a bear put right to a bull put spread, that may be the wisest adjustment to make. But now if the stock moves back down and we've got to move this in this direction, we can't go farther out in time. It's not a choice because we can't extend it past the time of our long put. So if instead of rolling straight up, if we can roll up and in and be in some type of a calendar spread. If it reverses and we have that more difficult adjustment to make, at least we've got time out in front of us that we can still push it out to and improve the chances of a more successful adjustment going that direction. Okay, let's look at money in, money out now, because everything we do centers around money in, money out. When we open this trade, we've got our options. We want to remember our cost basis. Okay, everything is about money in. When we open this trade initially, we would have paid the ask price and we would have got a credit on the bid price. Now we've got the stock reversing. We're going to make an adjustment. So we're going to buy to close. This is our short option. We're going to buy to close our short option. If we're spending money out, it's probably in the ask column. So whatever we took in initially as the credit, we're paying $1.51 right now to move that. And if we're going to move it into a nearer term expiration, if we're going to go from September 2017s to August 2017s, we're going to have to go up in strike from the 100 to the 105 in order to get enough credit to make it a positive situation. So here we're changing from a bear put spread that we have. We're rolling this option from here to here. We're going to a nearer term expiration. We're going up from the 100 to the 105 strike price. And when we spend $1.51 to close and we take in $2.07 to open the new one, we have improved our cost basis because we're still in a debit spread, but we have now lowered our cost basis by 56 cents per share. That's ideal. The most ideal scenario in an adjustment is if you can get in a more favorable strike price and improve your cost basis. Whatever adjustment you're making, if you can get into a more favorable strike price and improve your cost basis. On a debit spread, improving your cost basis is lowering it. On a credit spread, you might want to bring in a greater credit, which also lowers your cost basis, but you're actually bringing in a more credit. That's why we say improve your cost basis. Okay, if we had a more bullish trend happening, same trade, it's all about money in, money out. We pay $151 to close the existing option. We go straight up to a higher strike price. We go from the 100 to the 110 strike price. We leapfrog the 105, but we stay in the same expiration. And now we're bringing in a big enough credit that we are probably changing this from a debit spread that originally had about, that's right in the ballpark of a 145. In fact, I think that is 145 debit. We're going from a 145 debit, and if we subtract 145, well, if we subtract 379, that new credit minus the 145 debit that we started out with, now we have a $2.34 credit spread. Have we improved our cost basis? Yeah, we have. We've got a more advantageous strike price and we've improved our cost basis. Okay, I'm going to, I don't do this very often, but I'm going to back up. I'm going to back up to this chart real quick. I want to go back here because I feel like I kind of missed this. A question gets asked to me all the time: when do you make the adjustment? How do you know when it's time to make the adjustment? Could you make the adjustment? Would you do it on one of these 2 days right here? No, probably not. When a stock is trending down, through this entire downward trend, from where it peaked right here to where it bottomed out right here in this segment of time, here are 2 days in a row that it traded to the upside. Here's a day that it traded to the upside. Here's a day that it traded to the upside. If we would have made an adjustment, let's say hypothetically we had that crystal ball that we're always talking about, and we got into our bear put spread right here. Somehow, some way, we determined that it was going to go down from that point forward, and we jumped into a bear put spread. We'd be kicking ourselves if we had adjusted right here. We would be hating life if we had adjusted right here, if we had adjusted on this day right here. So when you get a couple days in a row of upward movement, you can't automatically go to an adjustment. If you do, there's a good chance you'll be adjusting the other way. if you're going to make the adjustment to a bear put spread, if you're going to make that stagnant adjustment, you've got to wait until at least a week's worth of trading has told you that this bearish trend that you thought was going to continue down a little ways, wait at least a week when you sense that you're starting to flatten out a little bit. Give it 1 week of that flattening, then draw your most recent trend line and say, okay, with my option expirations right here, I'm not going to get down far enough on that trajectory. That's when you might make the adjustment for the still bearish but flattening trend, or the bearish move is slowing down a little bit. But if you're going to make an adjustment to a horizontal call calendar or a bull put calendar, or excuse me, horizontal put calendar, I'm so sorry. If you're going to make the adjustment to a horizontal put calendar or to a bull put calendar, where your long option is here and your short option is either at the same strike price now or at a higher strike price, but either one in a nearer term expiration, don't do it before you get technical crossovers. Okay, don't make that adjustment until you get those technical crossovers. Then you start looking at your levels of resistance and saying, okay, now I've got this change of trajectory. Do I want to go right into a bull put spread by moving this up here? Preferably you go into a calendar and you still give yourself the ability to roll if it reverses again. So I wanted to go back and make sure that I feel like I kind of skipped past that when we were at that point. All right, let's go ahead and wrap things up now. To summarize, when a stock is when we have a bear put spread and the stock moves into a slower bearish trend or somewhat of a stagnant trend, we can roll our short put in or up, probably both. Probably we're going to do both. We can short additional puts after our first set of short puts expire, or we can start rolling the puts. We can wait for something to expire and add a new one, or we can roll it. When a stock in a bear put spread moves into an outright bullish trend, we can roll our short put in and up to a higher strike price than our long put. We could create a bull put calendar. We might start out in a horizontal put calendar for maybe a week and then move into a bull put calendar. Or if it looks like that new trajectory may carry us a little bit higher, a little bit faster, and we're making an educated guess. There's no question about it. We're making an educated guess. You could roll right into a bull put spread, but remember, if you roll directly into a bull put spread, if you have to adjust past that, it's a very difficult adjustment, relatively speaking. Try, if at all possible, to do a put calendar or a bull put calendar ahead of the adjustment right into a bull put spread. You'll be far better off. Always keep track of that cost basis and how it changes every time we roll options. Money in, money out. Keep adamant track of the money in and money out, and never lose sight of where you're at on that, so you always know where you could potentially close the trade on a net money in or a net money out basis. You need to know where you could close that trade to be at a break even versus a 5% loss versus a 5% profit. Always keep that in mind. Folks, that wraps up adjusting the bear put class. Thank you for your participation. We'll look forward to seeing you in the next class. Bye-bye.